What's up, everybody? Welcome to another episode of China Update, where I provide you guys with the most up-to-date political, economic, and geostrategic analysis on the world's number 2 economy. My name is Tony. Let's jump in. Happy Monday, everybody. Hope you had a great weekend. Let's start with the economy. Over the weekend, Beijing concluded its Central Economic Work Conference, an important annual event which sets the tone for economic policy for the following year. With so much uncertainty surrounding how Chinese leadership wish to proceed with China's economy, this year's conference has been followed especially closely. State media commentary of the economic conference reflected the feeling of the leadership well when it expressed, quote, "We are facing threefold pressures, including contraction of demand, supply shocks, and weaker expectations. Our policy support should be front-loaded appropriately," end quote. In a 4,700-word statement released by the event, the word stability appeared 25 times. The statement expressed, quote, "We should continue to implement a proactive fiscal policy and a prudent monetary policy. Active fiscal policy should improve efficiency and pay more attention to accuracy and sustainability," end quote. Now let us now move through the official statement and state media commentary and pick out key themes. Remember, the Central Economic Work Conference is what everyone from state-owned enterprises to central economic planners to local officials will reference to know what the politically correct economic policy will be going forward, so it has strong influence. Now, just because the document says something doesn't mean that's what is going to happen, but it does have a strong influence on many decision makers in the wider economy. The term, quote, "prevent disorderly expansion of capital," end quote, which we have seen a lot in the past, has been replaced with, quote, "prevent the barbaric growth of capital," end quote, which is much stronger language, suggesting even more regulatory intervention in capital markets. Domestic capitalists should be nervous. This is how it was articulated, quote, "It is necessary to set up traffic lights for capital, strengthen effective supervision of capital according to law, and prevent the barbaric growth of capital. We should support and guide the standardized and healthy development of capital, adhere to and improve the socialist basic economic system, unswervingly consolidate and develop the public sector of the economy, and unswervingly encourage, support, and guide the development of non-public, i.e. private, sector of the economy." The readout expresses that some infrastructure investment will be accelerated. Now, we've seen this coming over the last few weeks. This confirms the infrastructure stimulus that we've been talking about for the last few weeks is indeed coming in 2022. We saw language about strengthening anti-monopoly work and for fighting quote-unquote unfair competition. This especially affects the technology sector. Common prosperity is comprehensively discussed in the document. If it wasn't obvious before, common prosperity is clearly a flagship economic policy for Xi's circle, so expect more common prosperity related policy in the future. We have discussed the so-called common prosperity a lot on China Update already, and we will continue to discuss it in the future because, like I said, it is going to play a key role for top policymakers. Now, onto housing. The phrase "houses are living in, not for speculation," appears, but it is hardly thoroughly explored. So this is all sending a bit of a mixed signal. We're getting some mixed messages here from these two readouts, the Economic Work Conference today and the Politburo meeting last week. The government will likely continue to push for more rental properties and the construction of affordable housing. However, the vague language does give local officials a bit more political cover to loosen the regulatory environment and open up credit to the property development sector if it wants. And many local governments certainly do. Okay, to coincide with the economic work event, the Executive Deputy Director of the General Office of the Central Financial and Economic Affairs Commission, that is a very long title, it's an important position, that's all we need to know, penned a commentary in the state-run People's Daily, which was published over the weekend, also discussing the critical role of technology and self-reliance as it relates to China's broader economic performance going forward. And this is what was expressed, quote, China must correctly handle the relationship between self-reliance and open cooperation. Science and technology innovation is the basic element to support national modernization. Experience shows that if late developing countries do not want to be stuck in the low end of the industrial value chain and stagnate, they must firmly promote the self-reliance and self-improvement of science and technology. So again, a stress on this idea of self-reliance, which we've been hearing a lot since about mid-2020. We've only seen some policy rollout, but I think this is a sign that we're going to see more so-called self-reliance, technology decoupling as we move into 2022. As we've discussed over the last few weeks, China is likely to set an economic growth range of between 5 and 6% for next year. And based on this economic work meeting, this prediction still stands. On Saturday, speaking at the Greater Bay Science Forum in Guangzhou, leading public health expert Zhong Nanshan expressed that China needed to learn from the West about advanced mRNA vaccine technology, expressing, quote, we should learn about the good things in other countries, such as mRNA vaccines. They have spent years on the research and managed to develop mRNA vaccines in just a few months, end quote. The speech coming within the context of a wider debate within China about the wisdom of having a very expensive and disruptive zero-tolerance policy where just one case can cause large-scale shutdowns of cities. Currently, the zero-tolerance policy still enjoys majority support, however, among the elite of the country. China reported 51 new local cases on Saturday, these are official numbers, with 35 in the wealthy eastern province of Zhejiang, which hugs the major city of Shanghai. This number increased to almost 100 yesterday. More than a dozen major Chinese-listed companies have said that they have suspended production in Zhejiang province in response to local government demands to fight this new outbreak. Now, the speech was also made within the context of concern in China that the Sinovac vaccine may not be very effective against newer variants of COVID. Meanwhile, according to the National Health Commission, China has fully vaccinated 1.17 billion people, or 82.5% of the population. By the way, guys, if you're enjoying the content, don't forget to hit that like button. It's the only way a small YouTube channel like this will be seen by more people, so it's a huge help. And if you're getting some value from the analysis, maybe consider subscribing. Hit that bell notification. You'll have the most up-to-date China analysis as it's released every day. Cheers, guys. And last up, a quick update with the Chinese housing sector and the Evergrande Housing Crisis. According to Bloomberg's investment unit a few hours ago, a sudden drop in bonds of developer Shimao Group holdings sparked a broader sell-off amid, quote, renewed concern over the health of Chinese property firms, end quote. Chinese junk bonds fell after Shimao's dollar bonds dropped as much as 10 cents on the dollar. Its Hong Kong-based shares dropped almost 14%, almost their biggest loss since 2008. Shimao is China's 13th biggest property developer by sales and among the largest property debt issuers, with about 10.1 billion US dollars in outstanding local and offshore bonds. Of course, we know that last week Evergrande and Kaisa Group both defaulted, and Evergrande's restructuring has been taken over by a local government working group. We learned too over the weekend that the chairman and founder of China Evergrande Group has been forced to sell shares to fulfill an obligation, a financial obligation, with his stake in Evergrande dropping from 61.88% to 59.78% between December 6th and 9th. Last month, China Business News reported that the founder had been told by the government that he was to use his own money to repay Evergrande's creditors, reporting that he had already used 8 billion RMB, approximately 1.1 billion US dollars, of his own money to pay bond interest or staff salaries. Hey guys, I'd love to hear what you thought about some of the updates we covered in today's episode, so throw your comments below. Always love hearing from you. Thank you for watching. I'll see you next time.